Welcome everybody to Financial Statements, a snapshot into your business with Mike Sandman. He is one of our SCORE Boston volunteers and gives a handful of presentations for us, and we're very happy to have him with us here today. And as we get started, in case you aren't familiar with SCORE, we definitely would like to tell you what we do. We share information to the business community. That is our primary goal. And we do that in a couple different ways. One is through our website. If you've not been on the website, I strongly suggest you have a visit and take a look around, score.org. There's lots of information in that library section. There's templates you can download, not just business plans, but marketing plans and cash flow and budgeting and all kinds of different kinds of templates. There are blogs you can read, articles you can read. There are recorded webinars you can watch. There's just a wealth of information. The other way we provide information is through our workshops and our webinars. Most our webinars, we do have a handful of workshops in person. So I encourage you to watch for our newsletter that comes out regularly. We also post some of our events on social media, and they, of course, are listed on our website. So definitely take a look and see what we have coming up. We have a lot of great topics for this late winter heading into spring, fingers crossed. And the other important way we give information is through our mentoring program. Anyone can have a SCORE mentor. You do not need to have your LLC already created. You do not need to have your business plan already created. And in fact, we prefer you come to us at the very beginning before you start making investments into your business. Our volunteers have a lot of different experiences and backgrounds. They have things to share from their successes, from their failures with you. So we're working with those that, like I mentioned, are trying to decide if small business is right for them. We're working with those that are in that planning phase, and we're working with those that are already in business. And folks come to us with a variety of business questions. And if we can't find somebody in our chapter, we're going to reach out to the national level to find somebody to help you. Although generally we can help you out right here in your local chapter or the district area. A beginning session's about 45 minutes. They want to know about you. They want to know what your goals are, what your challenges are, and they're going to work to help you put together a plan to reach those goals and overcome those challenges. And the wonderful thing about SCORE is, yes, you're meeting with maybe one or two, depending if you have a co-mentor on that session, mentors on your session, but you're actually meeting with the whole team. They work together. They are constantly emailing each other. They're constantly inviting other mentors to come in and join, because they want to make sure that you get all the best information you possibly can. So getting a mentor is very easy. Score.org website, I mentioned it earlier. Go to the blue box, put in your zip code, and that will connect you to the chapter that is nearest you. It's going to ask you a couple questions, and that information is going to be used to help match you to the mentor that can best assist you. We do anticipate a very, very large crowd today. So please, please, please use the Q&A button for questions for our presenter. I can't always find them in chat because chat is constantly scrolling up. It's just easier for me to keep track. So if you have a question for Mike today, please put it into the Q&A tab on the Zoom bar, as the button on the Zoom bar, and we will address questions when it's appropriate, and we will do our best to get to as many as possible. We are recording, and this will be on the score.org/Boston website. As shown by the graphic, it's on the blue bar under the local workshops, previously recorded webinar. Give me about 24 to 48 hours to get it posted, but that is where you'll find it. So I'm going to go ahead and pull this down. And Mike, it's all you.
Okay. Thanks, Teresa. Okay. Welcome. We're going to walk ourselves through the three major financial statements and one other very useful financial statement sort of tool, and describe what each one of these things will do for you, what it will tell you, and take some questions, a few questions perhaps, as we go along through it. So we're going to talk about balance sheet, what use it is, and then profit and loss statement, the concept of startup costs and cash projections. We're going to look at the formal cash flow, the uses and sources statement, and then we're going to go from there and actually look at how to put together a cash flow projection, looking out a year for a startup business. And the standard financial statements that you get are the balance sheet over on the left side of the screen. Over in the middle is the P&L, and on the right is a cash flow, the uses and sources statement of where money has come from and where it's gone for the year. And these are the things that QuickBooks or any other standard financial package will give to you. And these are the kinds of things that your accountant, if you're using an accountant, will prepare for you as well. So it's very important to understand. Excuse me. Understand what use you can get out of them, what you can learn from them, and how they fit together. Because you'll see a lot of numbers that will be. Excuse me, I'm recovering from a cold here, so I'm just gonna cough for a second. Okay, hopefully that'll do it for a little while. You'll see a lot of numbers here that recur on one sheet. They show up in another place on another sheet. These things all tie together. They're very, very closely linked, and we'll talk a little bit about how they are linked. In addition to those three standard financial statements, we're going to look at a cash flow projection looking forward, not back, not a uses and sources, but rather what's going to happen next for a startup business. And all of this is going to be around Joe's Pizza. Joe's Pizza is a pretty straightforward business. It's not huge, it's not tiny, and it has the advantage from the perspective of what we're doing of being a little bit complex because Joe has rental property. He's had to build out his kitchen. He's got kitchen equipment and so forth. So it's not just an online business where there's not a lot of investment. Joe's actually had to make some investment here, and it's a useful tool a useful thing to look at the fact that he's made certain kinds of investments and figured out where his money's coming from and going. If you have a simpler business, that's great. You don't have to go through some of this, but understanding how the whole package fits together is what we're after here for a business that does have premises, that does have inventory and so forth. So we'll come back to this cash flow projection. It's got an awful lot of numbers in it, and we'll take a look at the numbers in detail at the end of this presentation. Let's talk first about a balance sheet or position statement, as it's sometimes called. And what it tells you is what you own, what you owe, and your equity in the business. How much money you have in the business that is sort of a measure of the value of the business. It's not really a measure. The best measure of the value of a business is to look at the profit that comes out of it and project that forward and say, well, okay, that cash profit that's coming out is worth this much now. But there's just the same, the equity that you have in the business is very important to understand whether you have more assets than liabilities, and where those assets are, and what's the state of your liabilities. How many of them are due this year? How many of them are due in future years? So it tells you what your equity is in the business and whether you have enough capital in the business to manage it properly. And what it tells other people, a bank, landlord, a potential landlord, is whether the business is solvent. Are there more assets than liabilities? Is it safe to be owed money by this business? And a lot of times, these statements are used by lenders, whether it's a member of your family, a nonprofit lender, or a bank. They're used by lenders to say, will I get my money back after I loan this money? That's the thing that lenders are most concerned about. Sure, they want you to pay interest, but that's the way they make their profit. But most important to them, they want to make sure that you'll be able to give them their money back when it's due. And the balance sheet is one of the things that's really critical in explaining whether or not that's the case to a lender. So let's look at Joe's Pizza Palace as of the end of 2023. Joe is actually in pretty good shape here. He has cash in the bank of $34,673. He has $2,500 worth of food supplies on hand and beverages, 3,500. So he's got total current assets, assets that he could sell in the current year and turn into cash of $40,673. He also has some fixed assets. These are assets that he couldn't necessarily turn into cash in the current year unless he sold the whole business, but they're the they're the assets that the business uses to produce pizzas. So he's got some leasehold improvements that he's made. He's got tables and chairs and counters and so forth in the space that he rented. He has some furniture and fixtures that he's put in place. He's got kitchen equipment for $11,500, and these are the prices that he paid for it when they were new. Kitchen sundries. He's got some technology, a point of sale terminal, and Joe's been in business for a couple of years, and he's got an entry in there for depreciation, and that's a negative number. That's the amount by which the value of his fixed assets has declined as they are used. And we're going to talk about that in more detail in a minute because depreciation sometimes is a bit of an odd concept to get a hold of. But the net fixed assets that he has, $28,050. So he's got almost $38,000 of assets at their purchase price minus the gradual deterioration in the value of those assets. And so he's got total assets between current and fixed of $68,723. Liabilities, doesn't owe a lot of money. His payroll is up to date. He's been paying his suppliers. He's paying wages. He has some wages and taxes payable, perhaps from the last week or so. Total current liabilities, the amount that he owes now is only $1,700. But he got started in business by taking a loan from his Aunt Betty, and he borrowed $30,000 from Betty, and he hasn't paid any of that back. He's going to have to pay that back. Um, uh, but that's a long-term liability. He doesn't have to pay it in the current year. So his total liabilities, $31,700. The $1,700 of current and the $30,000 that he owes to his aunt. If you take the assets, 68,723, and subtract the liabilities, you get his owner's equity, $37,023. In addition to what Aunt Betty loaned him, Joe put in $5,000 of his own money when he started this business, and he's accumulated profit over the time that he's been running his Pizza Palace. Pretty substantial profit, and he hasn't taken all of that money out. He's certainly taken some out for himself, but this is what's left. That $32,000 of retained earnings are left. So his total owner's equity is, again, assets minus liabilities, $37,000. Assets plus liabilities add up to balance, equity plus liabilities add up to balance the assets. So you can see 68,723 in assets, 68,723 in total liabilities and equity. That's a classic balance sheet. It balances assets on one side, liabilities and equity on the other. It tells somebody who's banking some interesting things about Joe's business, and we'll take a look at what those are. So I do want to talk about depreciation, that $9,300 of depreciation. That's a negative number on the asset side of the balance sheet. Some assets have a value that lasts longer than a year. So furniture and fixtures in a store or a shop, computer, software, point of sale equipment, that sort of thing. Leasehold improvements, things that stay in the building, new lighting or flooring, anything that's screwed to the wall or the floor or the ceiling. And there may be some other fixed assets that are in the business. Some companies that are doing research and development, for example, will capitalize the costs of that. That is, they'll say that their research and development has a value beyond the year in which the money was spent. Those assets, though, do decline in value over the time. They wear out, they break, they need to be replaced. They're replaced by something different or something better. And certainly that's true of technology, and it might be true of some of his kitchen equipment and so forth. Depreciation is the approximation of the annual drop in the value of those assets. It's an accounting fiction of sorts, but it's still real money. In fact, the assets do decline over time in their value because they do get used up. And the depreciation each year is an expense that reduces profits, but it doesn't take cash out of your pocket. You've already spent the money to buy the asset. It does take cash out of your pocket at some point when you have to replace it. And so it's realistic to say that the value of those assets is going down and that depreciation is kind of a reserve. It tells you how much money you've already written off, how much deterioration has already been, and you have to think about, well, where will I get the cash to replace this asset when it goes down to the point where it's no longer usable? There are
Mike,
sorry, go ahead.
oh, I'm sorry. Go finish that one. I have a question though when you're.
Okay, yeah. There are federal guidelines, Internal Revenue Service guidelines about how quickly you can depreciate different kinds of assets. So some assets can be written off in 3 years. Some assets, like buildings, are 30 years because they have value for a much longer time. Okay, Teresa, go ahead.
Yeah, can you explain retained earnings? Are they actual cash and where are they kept if not in the bank as cash and assets?
Okay, good. So retained earnings is the value of what's left in the business after you take away liabilities. Let's go back to the balance sheet. That's a really good question. So retained earnings are what's left in the business. They may be in cash, but in this case, they also could be in these fixed assets here. They're a combination uh, of cash and the value of assets that have been accumulated over and above expenses over a period of years. So this is all of the profit that's left over from Joe's years of operation that he hasn't taken out, that he hasn't spent in some way. And you could say it's cash, and in fact, he has cash deposits of $34,000 in the bank, but retained earnings could be substantially higher than cash in the bank. It really depends on the state of the business and the how old the business is and so forth. But it's the sum of all of the leftover profits that haven't been used up in some way, either withdrawn or are earmarked to offset liabilities. So I hope that's clear, but that's a really good question. It's not just cash.
I have a depreciation question.
Sure.
How is depreciation handled for used items?
For a used item, it's really the same thing. If you buy a used car, for example, a used truck, it has an initial value, and there are guidelines for depreciating that asset over time as well. So there's no difference. The guideline may have a different number if it's used, but as opposed to new, but the process is still the same. The accounting process is the same.
Can you add into the cost of depreciation the increased cost of items?
No. So unfortunately you can't. Not on the accounting system, but that's also a really good point that it's one thing to say, let's go back and look at the balance sheet again. One thing to say, well, we've invested $9,500 in furniture and fixtures, but if we had to replace those today with inflation, it might be $12,000 worth of cost. There's no mechanism, unfortunately, in the accounting statement for accounting for that. There really should be, but it's never been there, and probably is not going to be in the accounting profession. It's something that you do have to be aware of, though. So that's another really good point. Okay. What does the balance sheet tell us? What does the lender look for? the current ratio, sometimes called the working capital ratio, current assets divided by current liabilities. That number should be above 1 to 1. Joe's is a lot higher. Let's go back and look again. Joe's balance sheet. You can see that his current assets are $40,000 and his current liabilities are tiny. Now, he does have this big debt sitting out here. So a lender's going to look at that as well. But from a current ratio perspective, he's in really good shape. Quick ratio, current assets minus inventory divided by current liabilities. And that tells somebody if you needed to buy something in a hurry or you need to pay something off in a hurry, how much money could you generate? Well, your inventory takes some time because you have to sell the product, whether it's pizza or shirts. So you take the inventory out. My current assets are things that really I can turn into liquid cash very, very quickly. That number also should be above 1 to 1. Joe's is way higher. He does, as I say, owe a significant amount to Aunt Betty that starts coming due next year. But right now, Joe's in really good shape. And in fact, looking at what he owes to Aunt Betty, he's got more cash than he owes. Somebody looking at this would say, maybe Aunt Betty, if he came back and asked for some more money for another pizza parlor, somebody would say, okay, this business is in good shape. The debt to equity ratio is the liabilities divided by the shareholder equity. So Joe's is about 0.86. A number under 1.2 to 2 is good. Let's look at the balance sheet and see how we get that. Liabilities divided by shareholder equity. So liabilities, 31,700 divided by equity, 37,000 is 0.86. If this number was much smaller, total owner's equity, if Joe had been taking out all his retainings in cash in order to do whatever he wanted in his personal life, then that ratio wouldn't look as good. But this one does look very good. So Joe has been prudent. Okay, that's balance sheet.
I have a
So
balance sheet question.
yeah,
Can you go back to the
yeah.
balance sheet, please? Can you explain how the total assets and the total liabilities and equity are equal?
Oh, I'm sure. I mean, it's a uh, it falls out of the calculation. If you add up all of the assets, you add up the liabilities are X amount, 31,700. You subtract the 31,700 from 68,723, you're going to get a number that, when it's combined back with the liabilities, equals the assets. So that's what those arrows are there for. Assets minus liabilities equals owner's equity. Assets, liabilities, equity. Add these two back, they have to come up to the same number.
Thank you. I have one more question.
Yeah.
Owner's salary, is that a part of retained earnings?
No. Retained earnings is money that hasn't been spent and is left in the business. The salary will come out of the profit and loss statement. We'll take a look at that next.
Okay, thank you.
He could take, if he wanted to, and the cash was there, and it is, he could take some of that money out of salary, but he hasn't chosen to do that. If he took it out of salary, it would reduce his cash, it would reduce his retained earnings, and it would reduce his profit. But he'd have the money. Again, that is, he'd have the money in his wallet. So there's nothing wrong with his doing that as long as he doesn't take so much out that he damages the viability of the business. But this business in good shape. Okay. We looked at ratios. Think about your own business's financial ratios. Look at the current assets, the quick ratio, the debt to equity. Calculate those ratios for your own business and think about what they tell a lender. What do they tell you about how a lender will view your business? It should say your. I promised Teresa that all the typos were gone, but and what could you do to improve your position? Well, one thing you can do is try to pay down debt. You can if you have a business where you've loaned yourself money, you try and pay that loan back or turn that loan into a bank loan or something of that sort. But the main thing is how will the lender view your business? Okay, profit and loss statement. So what do you think of when you hear the bottom line? Most people think about, okay, it's the profit, it's what's left over. The profit and loss statement tells you how much money came into the business from customers, how much went out to pay expenses, pay you, that's your salary, pay your employees, your suppliers, whatever other expenses you had, the landlord, taxes, whatever, and shows you what's left at the end of the month or the end of the quarter or the end of the year. It tells other people how likely you are to be able to pay for your expenses in the future. So the balance sheet looks at where you are today. The P&L tells you how much you've earned in the past. And if you think about the likelihood that that P&L is representative of the future, it tells you how likely you are to be able to pay for expenses in the future and whether you're a good risk. Again, looking at it from a lender's perspective, but also looking at it from your own perspective. Is this a good business? Am I doing okay in this business? The P&L is perhaps the thing that people look at the most carefully. So let's look at Joe's profit and loss statement. He has $486,000 worth of sales of pizzas that he's sold and other stuff, Cokes, and maybe he's got an alcohol license and selling beer as well. I'm not quite sure. Have to visit Joe's and find out. He's got three kinds of business. People who come in and they have a pizza there. They sit down at the table that he's bought, or takeout. They come in, they take it out, they go out in the car and they go, and he has a delivery business. And he's keeping track of those separately because they actually have different cost structures. And you'll see later on that if he opens a second Joe's Pizza Palace #2, the speed at which he builds up business in each one of those categories varies. His operating cost, here's his labor, including Joe. So he's paying himself and the people who are working for him. He's paying payroll taxes. He's paying health insurance. His total labor costs are $235,000. And his food and related supplies are, well, his food, 97,200. Beverage supplies, I guess he must have some beer in there. Pizza boxes and delivery fees. He's paying a delivery fee to one of the organizations that will deliver his pizzas for him. And he's got $166,400 worth of food and related stuff. He's got occupancy costs. He's paying rent. He's got phone and utilities, and he's got some liability insurance. And those are his occupancy costs of $31,160. And then he's got administration and depreciation. So here again, each year, those assets lose a little bit of value. That's an expense. It doesn't mean that he spent cash on it, but it reduces his income. And by the way, that means it also reduces his tax liability. He's paying $3,640 for legal and accounting, and he's got a website. He's paying $605 for his hosting. So he's got administration and depreciation costs of $8,900. So his total operating costs, $441,724. That's $235,204 for labor, $166,440 for supplies, $31,160 for occupancy, $89,220 for administration and depreciation. $441,724 is his total costs. He's paying interest to Aunt Betty. He's not paying any principal back yet, but he's paying interest. So his total costs are $442,924, and he's made a profit. His revenue minus his costs are his profit. And then from that, he's got to pay $12,923 of income taxes. So his net profit is $30,153 out of that $486,000 worth of revenue. It's very important in people's mind. People sometimes they say revenue and they confuse revenue and profit. Revenue is what comes in the door. Profit's what's left over from providing the service or the product. And so that's not a bad profit. He's accumulated some previous profits in the business. That's where his retained earnings largely comes from. Okay. So what do we learn from his P&L? Is he making a reasonable profit? Yeah, he's doing pretty well. This is an interesting question. What would change if business slowed down by 10% or increased by 10%? And if it slowed down, how vulnerable is Joe to a slowdown? So let's go back and look at that because that's a really interesting question. So let's say that Joe's business dropped by 10% or dropped by $48,000 down to 400 and that would be about $440,000 worth of revenue. His wages might change a little bit, but not a whole lot. His food supplies would go down, presumably by that same 10%, so about $16,000. His occupancy is a fixed cost, doesn't change. His administration and depreciation doesn't change. He still has to pay interest to Aunt Betty. So he'd be missing about $16,000 worth of costs over here, but about $40,000 worth of revenue. His profit would be just barely okay. He might have $10,000 of profit if his revenue dropped by 10%. So it's an interesting illustration. A lot of restaurants had terrible problems, understandably, when COVID hit because all of a sudden their revenue disappeared. And it didn't disappear for a week, it disappeared for a year. And there was just no way they could stay in business. They had fixed costs, even if they weren't buying wages, buying labor, and buying food supplies and so forth. There was no way to sustain their businesses except by reaching into their pockets and seeing if there was anything there. But this tells you a little bit about the vulnerability of a business to ups and downs in the normal business cycle, leaving aside another pandemic. So Joe, he's doing okay, but he's got to keep his eye on the ball and keep that revenue up there. If his revenue increased by 10%, the same thing would go the other way. He'd have over $500,000 worth of revenue. His labor might go up a little bit. His food, so forth, would go up, but his fixed costs remain the same. So his total profit and his percentage of profit would rise substantially. Okay. Now we looked at fixed versus variable expenses, and that's an important thing to get in our minds. Every business has some expenses that are fixed, that are there, whether you get $1 worth of revenue or $10 worth of revenue or $1,000 worth of revenue. And occupancy, for example, website, those kinds of things, those expenses go on no matter what. And it's important to recognize how that you have to cover those fixed expenses no matter what's happening with your revenue line. Another question, how could Joe grow his business? So let's go back and look at his P&L again. He's got three categories of revenue there. One thing he might try to do is increase, say, his delivery business by advertising more heavily, or his takeout business for that matter, and see if he could bump those numbers up. He's probably filling his tables pretty well with his $174,000 worth of Eat It Here. But maybe he could do something different, add another food item, add a more expensive food item, something of that sort to increase his revenue. But he's got those different categories, and it's important to look at the different categories of revenue when you're trying to figure out how could I get more total revenue in there. Okay. Another way Joe could run his business, of course, is to open another pizza parlor. And at the end of this, we're going to look at that. We're going to look at what it would cost him to do that, and whether he can support that cost with the existing business. Okay, so let's talk about that a bit. If you're already in business, are you profitable? Have you figured out what your fixed costs are versus your variable costs? How can you grow your business? What new resources would you need? Do you need more people? Do you need more space? Do you need more capital? Do you need to do more advertising? What resources do you need in order to make that growth happen? And then where will you get those resources? If you're thinking about starting up, how much revenue do you expect to have when you first start? How much when you're 3 months into it? How much when you're 6 months into it? You won't start right from the beginning with a sort of the reverse of a cliff. If you're expecting to do uh, $100,000 worth of business a month at the end of that first 12 months, you can be sure in the first month that you won't do $100,000. It takes time to ramp up, and different businesses take different amounts of time to ramp up. If you're thinking about starting up, remember that ramp up period. How much will your startup cost be? How much did Joe put into his business? Well, he borrowed money from Aunt Betty. He had some money of his own, and he bought the furniture and fixtures and the kitchen equipment and so forth. We'll take a look at that again, looking at his balance sheet and try and figure out what his startup cost would be for another pizza parlor. And once you start up, what expenses will be fixed? What will be variable, like we've talked about? How long will it take you to start making a profit? So that is all the province of a cash flow forward-looking projection. What we're going to look at now is what comes out of QuickBooks or other accounting software is a backward-looking. Where did the money from my business come from? So, excuse me, just a moment. There we go. Okay, cash flow or uses and sources. What it tells you is where your cash came from in the last year, or the last period, where it was used, and whether you need to think about finding additional sources of capital, either for the business as it's going on or if you're going to try to expand. It tells other people whether you're able to finance the ongoing operation of the business without building up debt. Are you likely to have the cash needed to grow the business? And if you need more capital, will your cash flow likely support paying the interest and principal? Because remember, the lender is mostly concerned about getting the money back. They want it back on schedule. So let's look at the cash flow or the uses and sources statement as it comes out of QuickBooks. And it says, okay, we had a beginning cash balance of $5,300 at the end of last year. You remember that $486,000? That's how much money came in from revenue from those three categories of sales. You remember that we paid out $235,204 to employees, and we paid out cash to suppliers and for occupancy, and we paid some interest and some taxes. So we spent cash of $446,927, and that's the net cash flow from operating activities. That number is higher than the profit. Why is that? Because we also deducted $9,000 worth of depreciation from the profit because we had those assets that are slowly declining in value. But the cash flow is just purely cash, not depreciation, but cash. So that's the cash that came through the operation after the cash was spent. What did we use it for? So we spent $3,500 of it on the point of sale system, the registers and so forth. We did pay Aunt Betty back some money, $5,000 and some interest. And so this is the cash used in financing activities. And if you take 39,073 and subtract $9,700, we have an increase of cash of 29,373. Gives us, excuse me, an ending cash balance of 34,673. You've seen that number before. You've seen it way back here, 34,673 in his bank account at the end of the year. These numbers all tie together. They all fit. So cash at the end of the year is what's on the balance sheet. And where did that cash come from? Well, it came from $486,000 worth of sales minus $447,000 worth of operating expenses, and less whatever he spent on investing activities and on financing activities. And that's his increase in cash. Started with $5,300, accumulated $29,373, He's got 34,673 left. Again, that's back on the balance sheet. Okay, what are the main sources of Joe's cash? Well, his revenue. He didn't have investments anywhere else. What are the main uses? Supporting that revenue with supplies and labor and so forth. Are there any concerns like an increase in what Joe owes to suppliers? So if Joe had a high accounts payable, that is, he owed money to suppliers, that would show up here in on the right side of the balance sheet in a source of cash. And if he wasn't paying his suppliers, that he's basically using their pocketbook as a source of his cash, but that's not there. So Joe is in good shape. Does he have enough cash to operate the business? Yeah, he looks really good. He's running a good pizza business here. Does he have enough to expand, or would he need more capital? So we're going to take a look at that next because that's an interesting question, and it's going to bring us to the forward-looking cash flow projection. So if you're already in business, create a uses and sources statement for your business, or if it doesn't come out of your accounting software or your accountant doesn't provide it for you, what are your main sources of cash? Where does it go? If you want to expand, will your cash flow be enough, or will you have to get more money from someplace? And if you take your balance sheet, your P&L, and your cash flow into consideration, if you do need more capital, is a bank or a nonprofit lender or Betty likely to look at all of these statements and say, oh yeah, this business, the proprietor knows what they're doing here. It's okay, it's safe to lend them more or give them more money. If you're thinking about starting up, once you get started, where will your cash come from? What are the major expenses, and how soon do you think the business will be able to cover those expenses? What's that ramp up in your sales? And when will you get to the point of having at least as much cash coming in as going out? And that's what we're going to look at next. Taking your expected P&L and cash flow into account, if you were lending money, would you give yourself a loan? So let's find out. So I want to talk about startup costs because this is particularly if you're starting a business or expanding a business for that matter, there's a startup cost to that. So here's Joe's balance sheet. What can we tell from the balance sheet about how much it cost Joe to start his business initially when he started up? Well, here it is. He had $12,000 worth of leasehold improvements, $9,500 in furniture and fixtures, kitchen equipment, kitchen sundries, technology. He added all of this up, didn't have any depreciation at that point. He had to pay for all of this, right? So he had uh, about $37,000 and some change in startup costs. And besides that, he had to have some supplies, food supplies and beverages and so forth on hand. So altogether, he probably needed $45,000 to start the business. So he got that money and a loan from Aunt Betty, and he's already paid off some of that loan. Remember, he's paid off $5,000 of that loan to Aunt Betty, and he had some of that investment money himself. He'd saved $5,000, so that's where he got his startup funding. And you have to think about if I'm going to start up, what are my costs going to be? What do I need in fixed assets or in current assets? What do I need in inventory, or what do I need in a website, or whatever it is that you're going to have to build out? And think about, well, where will I get that money? And then also think about the operating costs of the business, just like we had in Joe's business when we looked at his P&L. So what does he need to start his second pizza palace? Let's take a look. We're figuring that he's got a pretty good starting cash balance. Let's say he's going to have a starting cash balance of 60,000. He's going to take his $34,000 and some change and a new loan from Aunt Betty and have 60,000 to start with. And here is what he has to pay just to open the doors of Joe's Pizza Palace number 2. He's going to expand his website. He needs some incorporation fees because he's going to set that up as a separate limited liability company. He's got to make a deposit on his rent. He's got that build out restaurant equipment. They're more expensive than they were when he opened his first one. He's got supplies, so forth. He's going to need almost $40,000, $39,200 to get started, to get going here. And it's not just the equipment, it's also the food supplies and the beverage supplies that he needs when he opens the door. So now we're going to do a cash flow projection using those startup costs and the operating costs and combine them. And what this is going to tell you is, well, where are you now? How much cash can you generate during the next year? Is that enough? Is that enough to run the business, to expand it? Do I have enough cash on hand to get this thing started, or do I need more capital? And if I have enough, will I have enough cash to expand and cover the cost of my borrowing? I have to pay interest, even if I don't pay the loan back right away. Tells other people, have I made realistic revenue projections? How long will it take for the business to start generating cash? And will they have enough at the end, at the beginning, to finance the business through that startup period when more money's going out the door than coming in? So a lot of times you'll be asked for this cash flow if you're starting a business, or even if you're running one and you're looking for a lender to provide you with some money, you'll be asked for this kind of thing. And we're going to walk through it now. I showed it to you at the beginning. We're going to walk through it in a little bit of detail. So Joe, he's going to have 64,673. That's his $34,000, 34,673 that he's already got in the bank, and he's going to ask Aunt Betty and get another $30,000 loan. So that's where $64,000 comes from. And you think, well, my startup costs are only $39,200. Why do I need that? Well, let's take a look and we'll see. So his first month opens up. He's got to pay rent. He's got to get his build out done and so forth. There's no revenue coming in. There's no money. So his operating costs are, he's got a part-time manager, and he's got to pay himself. But right now he's just going to pay himself. He's got to pay payroll taxes, and he's got health insurance to cover, and he's got liability insurance. So he's got $7,300 worth of expenses, and there's not a nickel coming in the door for revenue because he's just opening the door, washing the floor, painting the walls. It's his space now. He's paying rent on it. So he's got to cover those expenses. And by the way, he's paying rent. When he started up, he paid a month's rent and a month's deposit. So that's why that number isn't in there right now. So his total costs in that first month are $46,000, 46,540. His ending cash balance, he started with 64,73. His total costs, including startup, of 46,540, is a lot less money at the end of the month. The next month, he finally begins to get some business. $7,500 worth of eat-in, $2,500 worth of takeout, and $2,500 in delivery. That's his total revenue. That's how much money comes in the door in February. February is not a great month. It's cold. People don't, try a new place necessarily. He's got a couple of employees now in order to produce his pizzas and run the store when he's not there. He's got payroll taxes and health insurance and food supplies that he's got to replace. He's now paying rent. He's beginning to pay legal and accounting costs. He's got interest to Aunt Betty on the money that she's lent him. His total operating costs are $19,000, $7,000 more than his revenue. So his cash balance is going to get down again. And the next month, even though his revenue's begun to grow, it's going to shrink some more. And it's going to keep shrinking all the way into April. And it's going to get real close. So he's barely got enough money to get through to the point where enough business comes into the door, $34,000, to cover all of his operating costs in May, and then he begins to build up some cash. And you can see the process that goes on here. His total revenue slowly builds up. drops off in August because people go on vacation. They begin to come back in September, October, and then things cool off a little bit in November, and then December, there are lots of office Christmas parties. So he knows that this is the general flow of things once he actually gets rolling from his first pizza place. And he knows that at the end of the year, he could expect a little bit over $400,000 worth of revenue. His costs, the total, about $418,000. So he's had those startup costs and the operating costs. His ending cash balance is, excuse me, his ending cash balance 43,000, even though he started with 64,000. So that's his projection forward. This model, it's just a model, and it's just a model for Joe's Pizza if he was starting pizza place number two. But this model, this template, is something that you should use whether you're running a business and thinking about, well, how's my business doing going forward, or particularly if you're thinking about starting a business. So let me stop there. Actually, let me look at the next slide. What are your startup costs? Permits, licenses, fees. People sometimes forget about those. Technology, getting a location ready, the website ready, the digital version of the location, deposits besides rent, supplies, inventory, labor that he needs for setup, anything else you need before you open the doors. And your ongoing expenses on the other side, those are your operating expenses once you've actually got the business started. So those are the things you should be thinking about and putting back into this template. And obviously add lines and subtract lines as you need to. Okay. Where can you go? What's next? For accounting help, QuickBooks is a really good product. There are webinars that we run on QuickBooks, and I believe Intuit runs some as well. There's another product called Wave, which is less expensive than QuickBooks and probably not as detailed and as deep, but QuickBooks is a very detailed um, and very sophisticated product. Wave may be enough for a small business startup. Take a look at it. You may want to have a bookkeeper. We recommend that for people who want to get out there and actually run their businesses as opposed to sitting with the paperwork and the accounting. And particularly if you're using something like QuickBooks, you need somebody who knows how to set it up and do the data entry and do it accurately. You may want a payroll service, Paychecks, ADP, because what they do is calculate and pay the taxes on your employees, your employment taxes automatically. You don't have to calculate anything. They take care of all of it, and they cut the check for the payroll that both you and your employees will get, or they do direct deposit or whatever you want. And of course, you should be talking to an accountant. And you don't have to talk to a big firm, just talk to a local accountant who can help you get started. You can get help, and really the mentoring help should come first. Got to flip that around. You can get assistance from SCORE. So whether you're running a business or you want to start a business, we can sit down with you and help you think through some of this cash flow projection, help you explain what the various P&L and balance sheet and so forth statements mean for your particular business. That's what we do. And as Teresa said, we do that for free. We do that for as long and as often as you need help. We are supported by the U.S. Small Business Administration through funding from the U.S. Congress. So we can do this for free. And there are 10,000 of us all around the country who do this kind of stuff. So wherever you are, and whatever kind of specialized help you may need, we can probably put that together for you. Okay, that's all she wrote. So let's see if there are any other questions
Questions?
or
Yeah.
anything in the chat. Yep.
Yeah. So how often do you recommend somebody looking at their P&L? Monthly,
Oh,
weekly?
yeah. You should be generating a P&L every month, and certainly you should be taking a serious look at it every quarter, every 3 months. Yeah, absolutely.
Do you have any opinions on whether to use QuickBooks or Sage or something else for a nonprofit?
Doesn't nonprofit, there's no particular difference. Uh, Sage is a heavy duty, bigger, um, bigger package and perhaps more than a small business or a small nonprofit would need. But it's a very good product if if you need that level of if you need that kind of depth. But really, there's no significant difference in terms uh, uh, of the products themselves. They're meant for keeping track of numbers, and it doesn't matter whether it's a for-profit or a or a nonprofit. A nonprofit doesn't generate a profit, but it needs to generate overall. It needs to generate a small surplus that is effectively the same as a profit.
Um, does the P&L take into account retained earnings?
Um, no. So the P&L, what's left over at the well, yes and no. At the end of the period, there's a profit. That profit goes into retained earnings. So in that way, the P&L links up to retained earnings. But to say it, does it take into account? It's the other way around. The balance sheet takes into account the profit and puts it into the undistributed profit, puts it into retained earnings.
Should I be using a cash flow projection to gauge when to pay vendors? Sometimes I struggle with wanting to pay bills right away versus letting them sit
Oh
until
yeah,
their
good,
terms are
good.
due.
Yeah. If you don't have to pay the bill right away and you're wondering whether I should sit on this for a little while, take a look at the cash flow projection because it will tell you whether you're going to need that money, basically borrow it from the vendor for a month extra or something of that sort. Yeah, that's cash flow projection is a really good way of predicting what you can afford to pay back to your vendors and when. I mean, ultimately, you have to pay everything back to your vendors, but or you're in big trouble. But the timing of your payments, if the vendor will allow you some credit, the timing of your payments is something that you can work out by using a cash flow projection.
Okay. Can you recommend a program? This person happens to use QuickBooks Online currently that will invoice or send payment requests via text message.
By text message, I don't.
I
I think
know.
I don't know whether QuickBooks will do that. I know QuickBooks will send an invoice by email. I don't see any reason why I wouldn't be able to do it by text, but I mean, I've received. I have a somebody who comes and plows my driveway, and he sends me an inventory. Sends me an invoice by QuickBooks by email when he does it.
Yeah, the only way around that, because I'm actually a QuickBooks user as well, the only way around that I can think of is that if you, there's a way to text people through email. You have to know, what their service, what their service provider is, and sometimes you can find that out by the beginning extension of the number. And you can turn in, so then you would have to put that email into that client's
Okay, so
system.
if
It's so
so,
it would be a complicated go around, but
yeah, yeah, got it.
potentially could be done, but no, I don't believe it's built into QuickBooks either. Okay. Payroll sucks up most of my earnings. I'm not hiring the right people, question mark. How do I measure the return on investment with the people I do hire? And I hope this makes sense. Yeah.
That's a little bit of a complicated question. It depends on. So presumably, you're providing mostly a service as opposed to a product. And the question is, how much revenue are those people generating in return for what you're paying for them? And there should be for every business, every service business, there's some sort of rule of thumb as to what that is. I'll give you an example. I ran a consulting business for a very long time. And early on, the business, when I first came into it, it wasn't making a profit. And I sat down with somebody not from SCORE, but an advisor that we actually paid to help us figure out how much revenue each consultant and each consulting manager should be generating. And then we had a conversation with our staff, and we said, "Well, this is what we think you should be doing." And some of them said, "Yeah, okay," and some of them said, "No, I can't do that," and they left. Um, so, do you have the right people? Well, first of all, know what the standard is, what you should be expecting from them. And then have an open, honest discussion with them is what I would do.
Is there a download sheet about all ratios other than the quick current and debt to equity?
I'm sure there is. Hang on a second. There's a book. I'm gonna see if I can find this actually a bit of fine. Give me a moment. I'm gonna just step away for a second. Okay, now you're gonna laugh at this, but just the same, it works. Um, on here. There's a book, of a very short book, um, and here we go. Let's see if I can find it here. Where is it here? Here it is. There's something called Quick Study Business, Quick Study Business Financial Statements. And you can get it on Kindle from Amazon. You get an ebook, and it covers a lot of the detailed sorts of questions. And it's a relatively short. It's not a deep look, but it's very, very thorough in the stuff that it does look at. All of the statements that we've talked about in here are in there, and explaining where they come from and where they go. And in fact, there's a section on nonprofit financial statements as well. And there will be a section on ratios.
Okay.
And that's, like it's
Last,
$10 on Amazon for the Kindle version of this.
okay. Last question. How do you find an affordable accountant and bookkeeper?
Oh man. So there are bookkeeping services. I would say you have to be a little careful. You get what you pay for. And I've had a couple of score clients, or one in particular, who didn't pay attention to that uh, that aphorism and went to a bookkeeper in India who was really inexpensive. And the difficulty is that she didn't know how to code the expenses so that they put the expenses into their statements in an incorrect way, and it really messed up her accounting pretty badly. Um, so I would say, um, unless you're able to do a really good job telling the bookkeeper exactly where to put the expenses and the income, unless you understand the guts of the accounting statements, you should probably work with somebody who's onshore that you can actually sit down and talk with and look in the eye, and get references on. And you can find there are bookkeeping services locally, individuals or small organizations that will do bookkeeping for you. And in terms of accountants, same thing applies. Really, word of mouth is great. Talk to some other business owners about who they use. And by the
And
way, we
interview
have
more than,
references. I'm sorry, Teresa. We have a list of referrals that we can give to a score mentor can help you find can give you a list. We don't endorse, but we can give you a list of people that we know do bookkeeping and do accounting.
well, I think, and I think the rule of thumb, interview more than one person and make sure you have a list of what they charge so that you
Yeah,
understand the costs up front.
yeah. Understand the
Can,
thoughts. Yeah.
yep, can you repeat the title of the book and the author, please?
Oh, sure. Yeah. Let me open this up again. Hang on. It's the series is Quick Study Business Financial Statements. Let me go back to the very beginning of this thing and I'll get the citation of just a sec. Get the page all the way back. Here we go. Quick Study Business Financial Statements. It's a company called Bar Charts, Barcharts Incorporated. If you go on the Amazon website and you put in Quick Study Business Financial Statements, I'm sure it will pop up. And I think you can get it in print form too, although I don't, it works perfectly well on an iPad or a computer.
Let me just grab a name here. Okay, I just sent my email out. There was somebody else that said that they had a very long question. If you want to reach out to me via email and kind of give me a gist of what you're looking for an answer to, and I can certainly, if you don't already have a score mentor, connect you with somebody that can answer your question, that can, have a discussion with you about that. That is really the most effective way to get the answers that you're seeking. Okay, I think we've hit the end. Mike,
All right.
thank you so much. Thank you everyone for joining us. And we look forward to seeing you on our next presentation. Thank you.
All right. Great. Thanks. Thanks, Teresa.